The fundamental question of credit analysis is, what is the degree of risk that an obliger will have sufficient cash to pay back an obligation on a timely basis? The art of credit analysis is to understand how to convert historic financial and operating performance and financial condition into a judgment about an obliger's willingness and ability to repay an obligation in the future, and the degree of risk around that judgment. The traditional 4 C's of credit analysis still provide a valid, if simplistic, framework for this process, assessing capital, capacity, conditions, and character. An appropriate capital structure is one that provides adequate returns to the equity investors, while not incurring so much debt that the risk of bankruptcy becomes very high. A good credit analyst will always be assessing the quality of an obliger's capital structure and the degree of risk that it creates for the various suppliers of capital. A company's capital structure should be designed to match financial risk with the nature of its business risk. A company with very low business risk can safely assume a lot of balance sheet risk in the form of leverage. In other words, financial risk in the form of debt. A company with very high business risk will not survive for long if it also assumes a great deal of financial risk or leverage. The remaining chapters of this course cover more specific aspects of credit analysis, including the fundamentals of credit analysis, like cash flow forecasting and debt capacity, and assessing financial position, capital structure adequacy, and relative risk. Along with these, we'll cover short-term debt capacity and long-term debt capacity. We'll also discuss the goals and requirements of various suppliers of credit and capital to companies, including trade creditors, commercial banks, private investors, and institutional investors, and we'll cover the associated expectations about risk and return. Another few points this book will cover are credit facility structure and secured lending, modern risk management in commercial banks, and the concept and use of risk ratings in banks and by rating agencies.